Welcome to the Rim Break Rodeo. We hope this video helps.
You should start by confirming basic financial prerequisites, an emergency fund and manageable high-interest debt. Once you have that, open the appropriate account for your goals: brokerage for taxable investing, IRA for tax-advantaged retirement, or use your 401(k). You pick index funds that match your risk tolerance. For simplicity, a total market or S&P 500 fund covers broad exposure. Make sure to verify fund expense ratios and minimums before moving cash in, because fees and minimums directly affect long-term returns. Now you execute the core steps. Compare funds by expense ratio, tracking error, and tax treatment. You will choose between ETFs and mutual funds. ETFs often offer lower taxes and intraday trading, while mutual funds may be easier for automatic investments. Then set your asset allocation. Once done, split between U.S. and international stock funds and a bond allocation that reflects your timeline. Rebalance periodically to maintain that target, because drift changes risk exposure over time and can silently alter your intended portfolio profile. Finally, fund the account and automate contributions. Set recurring transfers to harness dollar-cost averaging. You should implement automatic rebalancing or schedule manual rebalances about once a year and after large market moves. This keeps your risk consistent. Monitor fees, tax forms, and trading restrictions so surprises are minimized. If you run into problems, failed trades, wrong ticker, or transfer delays, contact your brokerage first. Confirm settlement timelines, and then escalate to the fund provider if needed to resolve account or fund-specific errors quickly.
Thanks for watching. Consider subscribing if we helped you.